Well, we absolutely nailed what was going to happen for Palantir's earnings. They basically met or beat across the board, and we got an increase in the 2024 overall guidance. But next quarter's guidance being weaker than Wall Street wanted caused the stock to crash down, just as we discussed in our earnings preview video. Why did this happen, and what do you do as a shareholder in these situations? And is there big trouble brewing on the horizon? Well, let's discuss the good and the bad from Palantir's earnings, why exactly all this kind of happened with the price action, and I have a big warning for Palantir shareholders because there's big trouble possibly out there on the horizon. Just make sure you like the video if you like getting the truth without the hype. All right, so let's start off with the good things about the earnings first. They're basically doing exactly what we talked about on this channel for more than a couple of years now. They're just being steady and consistent, and all the numbers are rising basically right on target. Not crazy exponential growth through the moon craziness, but also not caving down or, looking like they're very seasonal or very much dependent upon the macro or anything else like that. Just steady and consistent no matter what all is going on basically in the outside world. Palantir is basically growing consistently through all of it. It just doesn't seem to matter. But we also had the pipeline of deals steadily increasing as well. So not only are we seeing growth basically increasing as well, we're also seeing the deal flow increase as well. But that is important, not for now, not for today. I don't care about the deal flow today. I know a lot of folks are out there making a lot of big projections and all these other things like that. And although I agree with the projections will come, the problem is not going to add anything to the stock now. It's in the future because we're going to have big growth in the future. So that pipeline of deals now that's, basically growing and continues to expand, it means a lot of money, potentially a lot of money coming to Palantir in the future, not this year. We're talking next year and beyond. And that's exciting for us as shareholders to see it early. And if you have that long-term vision in mind, you're not thinking short-term, you're thinking long-term, there's a lot of good things still to come that's being locked in now this quarter for potentially a year from now, 2 years from now, 3 years from now into the future. And one of the big bear points is finally starting to fall. We are seeing net dollar retention finally starting to reaccelerate again, guys. It had fallen for, 6, 7, 8 quarters or so. It had had a long drawdown of continually decreasing. And now we've finally seen it kind of bottom. And then we've had 2 consecutive quarters where that has started to reaccelerate again. And that is great news. Now, I don't think we're going to get to that 120% quickly, which is kind of where I think we need to go in order for Wall Street and all the bears to kind of say, okay, that's dead. We're not going to talk about that anymore. So we're not there yet. We got a long way to go. I think we're at 111 or so. But nonetheless, that is a good sign that instead of seeing it like it had been going down, finally bottoming, and we're finally seeing a couple of consecutive quarters now. A couple quarters can be considered a trend, and we got to continue it. Can't just stall out there. But that is definitely good news and a good sign that, hey, the last of the bear arguments there is finally starting to crumble and go away. I'm not talking about all the rest of the bear silliness that's out there. I'm talking about legitimate bear points that I can't point to and I can't deny and say, that's not true. That's just a bear being dumb trying to get stock price down. That's definitely one where they had a great point. I would agree completely with them. And we're finally starting to see that reaccelerate, but we are not over that hump yet. So we got to keep going. Got to keep moving forward with that one. So next up, let's talk about the bad with the earnings call. Now, I'll be honest with you guys, there really wasn't a whole lot of bad in the earnings call. It wasn't the greatest earnings call ever, or the greatest performance ever, anything else like that, but there wasn't a lot of bad either. I mean, really the only thing I can think of, and I wouldn't even call it bad, I would just call it kind of in the middle per se, not necessarily good, but not necessarily bad either, is the growth rate is remained steady at that 20%, which is not bad at all. It's really not terrible, but it also means that we're not going to get that higher multiple that we really want with Palantir, given the type business that they are. We would need to see that number creep up basically to that 25% or so. Obviously, I would love to see that 30% that we were originally talking about a couple of years ago. But nonetheless, just seeing it come to 25 can really give us some room with the valuation to really give us some room to run with this particular stock, because I know there's a lot of folks out there that have price targets in the future. And really the only way to hit a lot of those price targets is if we reaccelerate that growth back up to 30%. So there really wasn't anything bad in the report. But the one thing that I kind of say that I wish was better, maybe that was a better way to phrase it there, would be seeing that growth rate start to creep up, even if it was just, hey, we're going to hit 22% this year, versus 20, or, obviously it'd be great if we would have said 25 there, because I really think that would have given us a nice platform there to have a valuation reset for the stock there. But we didn't get that this time around. So overall, an excellent earnings call. Everything about it was excellent. Like I said, that's the only negative that I can kind of point to that I saw there that I just was kind of like, oh man, I won't call it a bummer, but it's just kind of like, that right there was one last opportunity there to really give us something, given how steady the business is and everything else, to kind of give us that jolt up. It just didn't happen. But of course, Wall Street beat it down. That's what they do. You have great earnings. You actually increase guidance for the year. And of course, they beat you down. And so let's talk about why that happened next. Well, there's actually three things that explain it all. Then we'll talk about what to do when this sort of thing happens to your stocks. And of course, we'll get to the warning as well. So number one, massive run up coming into earnings. Look, it went on a tear coming into earnings, jumping just 10%, over 10% the last 2 days before earnings. That is a massive run up in a stock prior to earnings. And we all know what happens. You run up into earnings. And guess what? Wall Street expects big things on that earnings in order to continue that run up. That's just the reality of the stock market there. Now, again, you guys know I tell you, don't try to play games around earnings. I definitely wasn't going short thinking, oh, well, they don't just have blown out of the water earnings, it's going to trade down. Yeah, that's the most likely scenario, but stocks are never more manipulated than they are around earnings. So for me, I have no desire to play those games and try to guess that because I've thought that before. And then actually terrible earnings came out and the stock still ran. So I've seen every bit of ridiculousness out there. It's not worth it. But in general, when you see that sort of run up into earnings like that, and a really good run up too, hard into earnings, I think it was 8% the day of earnings there, that's not a good setup unless you have blow it out of the water, unbelievable earnings. It's just a tough setup for you to be in as a shareholder. But that also speaks to exactly why I don't trade stocks, because it's really, really hard to guess those directions. Second, Q2 guidance was Wall Street's focus. This particular earnings season, Wall Street has been focused on Q2 guidance. They have not cared that you have raised guidance for the year. They are caring about Q2 guidance, and more specifically, not what you guided as Q2 guidance, what they felt the expectation was. And if you don't raise your guidance at least to their expectation, if not beyond, even if you raise your guidance for the full year, they have been beating down stocks repeatedly for that. Look at Meta. Same exact situation that happened to them. Look at SoFi. The same exact thing happened to them. Raising guidance, full year guidance, but having weaker than what Wall Street expected Q2 guidance. Still raising their Q2 guidance, just not up to what Wall Street wanted. And they got beaten down heavily for that. And we warned against that in the earnings preview. We said, hey, if Palantir doesn't have good guidance in that Q2 there, it's going to get beat down because that seems to be Wall Street's focus. And that is exactly what happened. And no, it doesn't matter that they got it just slightly below what Wall Street wanted. It didn't matter. Wall Street didn't see guidance above theirs. They beat it down. We can argue whether that's fair, not fair, whatever the case is. The facts are Wall Street is they control this, not us. And it's traders doing trader things. And if traders want to take it that way, that's exactly what's going to happen. And that's exactly what did happen to Palantir. And on to this last one here. And it honestly is the most important one to me as a long-term buy and hold investor. I don't care about what Wall Street's doing or anything else like that. This one right here is the one that I care about the most as a long-term buy and hold investor. Number 3 would be Palantir's valuation. Now, let me be very clear about this point. Palantir's valuation has continued to come down each quarter as they have performed. I would agree completely there. I also do not think it is crazy overvalued. And I also don't believe even the run up into earnings was a crazy overvalued scenario. However, given the growth rates, given if you just project out the numbers based upon the growth rates that Alex gave us at the beginning of the year for his guidance, even if I readjust it for the new adjusted guidance there, at the growth rate that they have, I had a valuation at the end of the year in the mid 20s or so for Palantir, which of course, if you count it from the beginning of the year until then, that was a great return. Unfortunately, Palantir ran up a whole bunch and basically ate up almost the entire, right before earnings actually, they went right up to exactly where I had fair value at the end of the year, right before this earnings call. I understand you can debate that, some of you guys have it a little bit lower valued. I understand that completely. And I can see that case because we don't know what multiple Wall Street's willing to pay for it yet. And a lot of folks maybe have it a little bit higher than that. Not crazy. If you're projecting out $40, I don't know I don't know what multiple you're using at this stage. It's a crazy multiple there. But nonetheless, I understand if you thought, hey, I really felt it was a $28 stock or so. Okay, I can see that too as well. But you got to understand, in the end, we are getting to the upper end of that valuation kind of band per se, that it will trade in there. And so it's not surprising again that when you're hitting the upper limit of that band this early in the year, I mean, we're only in May here, we got another 7 months to go. You're kind of hitting it kind of early there. It kind of makes sense for traders to kind of trade it down a little bit, especially after you have such a big run up after earnings. They're going to take their profits. And again, there was nothing blowout in these earnings. Now, totally different story if they would have said, hey, we're going to reaccelerate the growth. We really see growth accelerating at the end of the year. So we think we're going to be at 25% growth at the end of the year. Okay, that right there is the valuation reset. And I could definitely make a case for adjusting that price upward now. And now it's having more room to run. But right now, we're kind of running out of room in regards to valuation for the year so far. I'm not talking about 5 years from now or 10 years from now or anything like that, just simply for the year here. So to me, it made sense that those people who were looking at the valuation of Palantir and thinking it was a little bit rich, okay, I can't say that that's somebody being completely unreasonable and that doesn't make sense, because that's right around where I had it as well by the end of the year. So what do you do as shareholders in this situation? And I'll tell you exactly what scares the daylights with me in regards to Palantir stock. For me, this is absolutely where planning before the earnings call absolutely pays off. You need to understand what the valuation is for the stock. You need to understand exactly what your plan is for the stock, and then basically not necessarily react to earnings, but understand what you're going to do if it ran up after earnings, what you're going to do if it fell down during earnings, exactly where fair value was, and a lot of other things like that, so you could effectively deploy your strategy when that happened. And if all that seems like a whole lot, then just simply DCA into the stock. It is almost impossible to beat a straight DCA. You can do a modified DCA. We've been able to show in the group that, hey, a modified DCA can absolutely beat a regular DCA, but either one of those two strategies crushes traders. So don't trade. Just simply DCA into the stock like this, and you don't have to worry about it. Hey, guess what? If it would have ran up after earnings, you'd be buying the stock. Because it crashed after earnings or dipped down pretty hard after earnings, you'd be buying the stock at cheaper. It worked out in your favor either way. You didn't have to let emotions or your feelings or anything else play into it. You just simply continue to execute that DCA. But would I start a DCA in Palantir if I was starting a new portfolio from zero? Well, you can get that exact answer if you take the $250 legacy portfolio challenge, where you see in real time, I'm going to build a portfolio from zero all the way up to 6 figures plus, using nothing but $250 a week being deposited in the account. You can see, is Palantir one of those stocks that I would use to grow that portfolio quickly and fast, or would I choose other stocks? And if you want to learn how to do valuations and price targets and do that modified DCA and actually beat the DCAers out there, which means you're completely crushing the traders, check out a full membership where you get to take advantage of the $250 challenge, participate with us, and see our super investors who are also taking the challenge and beating me right now, by the way. And you get to take 5 courses for free. You get to take advantage of our free coaching for members. You get to be a part of the best 6, 7, and 8 figure Discord out there. See all my buy and sell alerts in real time across all my portfolios. See my complete watch list with price targets, which it's going to change for Palantir because you change your price targets every quarter after earnings kind of happens. And so much more, guys. The sale is getting ready to expire. Those $15 founder spots are almost all done. I think we got about 20% more to go or so. So 80% of them are gone. We got 20% left. Make sure you take advantage of that, or take advantage of a full membership that's on sale right now before those expire and the price goes up. Now for the warning about Palantir. I said it in our live stream on the Palantir earnings call, which of course full members get full access to that whenever we go live during earnings calls and talk about the earnings, that I know there's going to be somebody out there, and there's going to be people out there, the pumpers, that are just going to pump this thing to the moon and say, now it's game changing this and there's game changing that. And that's just not the reality of what's going on actually with the stock. We got a reiteration of the 20% growth rate, not a 200% growth rate, which is the only way I can justify some of the price targets that are out there for you guys. Now, I'm not knocking anybody. I'm not saying I'm right and they're wrong or anything else like that. But after doing this for almost 25 years, I pretty much can tell when there's a reasonable valuation and when valuations are extremely unreasonable and projections are extremely unreasonable. And I'm seeing some of that out there. Now, thankfully, I think a lot of folks have learned a lesson with that, and some of that is calming down. But nonetheless, it scares me still whenever I get folks in my group specifically that are DMing me videos or projections from somebody else, and they're just numbers that I'm just like, I can't get there. And I mean, it's not even like, oh, okay, you think it's, we're within 10% of each other, or even 20% of each other. We're talking, we are hundreds of percent apart. And it's like, wow, there is so much built into that. It's kind of like, the Tesla ones where people were saying Tesla would be at 1,500 today, split adjusted 1,500 today. It just wasn't reasonable. I had no way of getting there, regardless of all the successes and everything that Tesla does. And I see that sometimes in the Palantir community as well. And that scares me. So for me, understand valuation, stick to that, and don't buy into those hype projections. There is great things coming for Palantir, but it is going to be a slow growth beast. That's kind of my nickname for it. It's not going to be this to the moon type thing. We're going to get there over time, but it's going to take time as they continue to lay the groundwork and they play the long game. So I need you guys to play the long game too, not buy into the hype stuff. It's great if that happens. We all stand to win if they do, but just stay consistent. If that confuses you or you get emotional about your stocks or anything else, just DCA in the end. Share count is what is going to matter the most. In the end, that is what you want to focus on, is share count. So focus on that. And that right there will help you get rid of all the hype projections and everything else, because you're not figuring out when to go all in and, oh, it didn't do this, so I need to trade out and trade back in. No, just simply DCA into the stock, increase that share count. And over the long run, and remember, when I'm thinking about stocks, I think 3 to 5 years, sometimes even 10 years out, not projecting out that far. Just, I want the company to continue to perform. And if I hold it for that long, the companies tend to take care of me. I don't have to do anything. I can just sit back, relax, let the management team do exactly what they're supposed to do, and I make a lot of money in the end. And make sure you get your founder spot for just $15 for my group. There's only about 20% of those left, so make sure you get yours. 80% of them are gone, because when they're gone forever and the price goes up. Or get a full membership if you really want to take advantage and take your investing to the next level. Make sure you check out the pinned comment down there and see if a membership's right for you. And click this video here if you want to see exactly what I'm buying in this market. And click here to see my exact plan for this market. So thanks for watching, and we'll see you in the next one.